And now we are moving on to cash flow investing and why it is so important to us and why we believe that it is very important to understand that this is a long-term investment decision. This is not a get-rich-quick scheme. So be careful out there when you're listening to these gurus talk about becoming wealthy in real estate overnight. That simply doesn't happen. Long-term cash flow investing is a very conservative, safe way to not only build wealth for you, but to build wealth for generations to come. Cash flow investing basically means that you are going to be earning cash flow on the investments. But most importantly, not only are you earning that cash flow, you are also having someone else pay down the debt on that property that you have. Now, in some cases, you'll have no debt. There are people out there that are purchasing properties for cash. Then the cash flow becomes substantial. However, for our purposes, we're going to be talking about building a portfolio of real estate that does have debt attached to it. So we're going to be looking at not only creating cash flow, but paying the debt down on the property. We also caution our clients, be very careful about falling in love with cash flow. Because we believe in long-term investing, the most important part is owning the asset for free. However, the cash flow is a nice added benefit. The reality is today we've seen a giant run-up in real estate appreciation. Cash flow has become much more difficult. So if you are seeing giant cash-on-cash returns or giant cap rates, please be very cautious. It could very well mean that you're in an area that you don't want to be in. A lot of good properties in good neighborhoods simply don't see these giant cash flow returns. Again, we're more concerned about paying down the debt for free, and then whatever cash flow you have is just a nice added bonus. But again, the debt is the most important part of this.
Another very important benefit of long-term cash flow investing is the fact that the tenant pays down your mortgage for you. Now, how does that work? They pay rent, you collect it. You then take part of that rent to pay whatever the mortgage amount is. Let's give a $1,000 a month rental example. The rent is $1,000. You collect that $1,000 each month. Your mortgage payment is, say, $700 on that property. And you send in $700 of that tenant's $1,000 into your mortgage and pay down that mortgage. So depending on the type of mortgage you get, whether it's a 15-year or 30-year mortgage, the tenant over that period is going to pay that mortgage off for you. Now, the way mortgages work is over time, your payments become more principal, paying off more debt versus paying the interest. So as time goes on, the payments you're making on those mortgages are going more and more and more into the equity in your pocket. What other instrument in the world can you go out to a bank and say, I need some money, and they give you a mortgage, pocket full of cash to buy that property. And then someone else pays the bank back for you. That's the beauty of real estate. It's not even your money that's paying back the money you borrowed to invest. You can't borrow money from a bank to invest in almost anything other than real estate. And not only is it a great way to build your wealth and to get an investment that you don't have the cash for. You go to a bank, let me have some money. Then you buy a house. Then you don't even pay the bank back. The tenant pays the bank back for you. It's an amazing way to build wealth through leverage and through having someone else pay the debt used to purchase that asset. And that asset is all yours, even though you're not the one who paid it off.
Another benefit of owning real estate is appreciation. A lot like cash flow, we never sell on appreciation. We always look at paying the debt service, but then the cash flow and appreciation are just nice little added benefits on there. Appreciation has a lot of different things that could come into play. Different economic cycles, could be inflationary periods like we've seen. You could also see things that Scotty and I went through, like the Great Recession, where you saw no appreciation. So again, we don't want to sell on appreciation. We do want to talk about it and talk about the benefits that you get from appreciation. At its core, appreciation just means an increase in value on your property. Here, where we live in central Indiana, you can expect a 2 to 5% annual increase in appreciation. However, over the last 4 years, we've seen a much more substantial increase in appreciation. And people have really benefited from buying properties 10 years ago and watched this run up in their property value. For example, you can go back about a decade ago, and homes that Scotty and I bought in, say, 2010, 2012, in many cases have doubled or tripled in value, which absolutely crushes that 2 to 5% appreciation that I spoke about. Again, we believe in conservative real estate investment. We don't sell on appreciation. We believe in markets that actually have very little appreciation historically. Markets like Central Indiana or anywhere in the Midwest, you see that 2 to 5% appreciation in most cases. However, you could go to markets like, say, Los Angeles, the Bay Area, New York City, and you can see cycles where they have had 50% appreciations. We don't believe in that high appreciation market because the ups and downs can be something that really hurts a person. We want something that can be very predictable. Here in Indiana, yeah, we see 2 to 5% appreciation, but we never see a 30% depreciation. If you go back to those other areas in 2008, 9, 10, they saw depreciations of up to 50, 60% in some of these markets. That could absolutely be devastating to a bottom line for an investor. That simply doesn't happen in the Midwest or other safe real estate markets. So again, appreciation should not be expected or counted upon. It will happen. It's just a matter of when it will happen. But it's a nice added bonus to your real estate investment.
Now here's a benefit that might seem small, but over time, it really adds up and really changes the entire picture of your real estate, which is increased cash flow. What does that mean? Well, when you get a mortgage, a 15-year, 30-year fixed mortgage, your payment stays the same over that entire 15 to 30 years. Sure, the tax portion may go up a little bit or go down depending on what the taxes are, and insurance rates can fluctuate a little, but at its core, the mortgage amount stays the same. But you know what doesn't stay the same? Rents. Rents increase over time. The average rent increases across the nation for the last 10 years have been nearly 9% per year. Now, that's higher than we've seen historically. However, rent increases are a staple that we've seen since the beginning of time. Although you don't know exactly how much they'll increase, you can count on them to happen in some sense, especially if you look at it decade by decade and over the long picture view. Again, those increased rents are going to be going into your pocket. Your mortgage will have stayed the same, and those increased rents will just start adding up over and over. It can be exponential when you put this across a dozen properties. Now, what you do with those increased rents is also up to you. You can do accelerated debt pay down, where you pay your mortgage off early. You can use that extra income to purchase more real estate. So then your real estate is basically buying you more real estate. Now let's just not be too greedy about rent increases. One of the most important things is keeping your tenants. And to keep your tenants, you need to keep your tenants happy. So we don't believe in ultra aggressive rent increases. However, historically, rent increases happen. You can be conservative about it and still majorly benefit in owning real estate because you're going to be getting increased rents year after year after year.
Another benefit to real estate investing is the depreciation and tax benefits that you can receive. Now, first of all, I want to say, Scotty and I are not accountants, and it is very important for you to have an accountant on your team. We believe in formulating a team of professionals that can help you navigate these steps. Whether it be an attorney, an accountant, a realtor, make sure you stick with professionals that know that particular field. Whenever you start real estate investing, find that accountant and ask them about the depreciation and tax benefits that they get from real estate investing. The depreciation can really help you whenever you're doing your taxes. Other tax benefits are whenever you're doing improvements to a property, those are all costs that really go against your income. There's also things that you need to discuss on whether or not you can be classified as a real estate professional or something that you're doing on the side. Scotty and I, we are real estate professionals, so everything that we do to all of our properties is tax deductible. Along with some of our trips, whenever we're fact finding on areas on where to invest, those can be tax deductible as well. But again, the tax benefits that you get from real estate investing are exceptionally important. And again, I can't go into detail on a lot of it because I'm not an accountant. But make sure that you make this a top priority in your real estate investing journey. Contact an accountant. In fact, contact several accountants, interview them, and talk about the tax advantages and benefits that you get from real estate investing.
One benefit about real estate that a lot of people don't realize is the fact that it's a real-world asset. Bitcoin is not a real-world asset. Even stock in a company isn't a real-world asset. It's a piece of paper that says you have ownership in that company. That company is an asset, and you have a piece of paper that says you own part of that. However, it's not a real-world asset that you own and hold. Real estate's very unique in that sense. I buy some gold and silver. I'm a doomsdayer. I get scared, and so my wife lets me buy a little bit of gold and silver to hold. And there sure aren't many real-world investments that you can get actual returns, much less compounding returns like you're going to get out of real estate. It's the best of all worlds. Compounding returns on top of being a real-world asset that you can leverage. It's an amazing, amazing ball of benefits all in one.
One thing that makes real estate investing exceptionally unique is that it's really the only investment that you can borrow in order to acquire it. Think about it. If you went into a bank and said, hey, I'm looking to buy $100,000 of cryptocurrency, you think they'd give you the money for it? Absolutely not. Or really any investment like that, any security, gold, anything that adds value to your portfolio, you're not able to borrow to be able to acquire it. Real estate is exceptionally unique because you can use other people's money in order to expand your portfolio. Make sure that you have the right people on your team. Just like attorneys or accountants, having the right mortgage broker is very, very important. Just going into your local big bank brick and mortar location is not the best idea. There are mortgage brokers that specify only in investment properties, and those are the ones that you need to go after. On our Homeboys website, you can find some of the mortgage brokers that we prefer to use. Keep in mind, there's not a ton of mortgage brokers out there that specify in only investment properties, so make sure you seek out one. Now keep in mind, there are rules and regulations when acquiring real estate. As far as number of properties, your debt to income, they'll be able to help you navigate all of that. Make sure that you use the benefit of leverage to increase your real estate portfolio. Not only will this help you achieve your wealth, it will help you achieve wealth for many generations to come. It will help you expand your portfolio quicker, and then you have that tenant paying down the mortgage to where at some time you will be able to pay off loans on your investment properties, which then opens up other doors for real estate investment.
Welcome to the section that nobody else talks about. Ooh, the drawbacks and the risks. But don't worry, it's going to be okay. We'll make it through this together. First off, one of the big risks with real estate are market fluctuations. Market fluctuations happen where properties go up and down in value. Now, over a long enough period, real estate, you can look at any chart, it appreciates over time. However, when you zoom in on a 10-year section anywhere, there's a lot of sections where you'll have some dips. Market fluctuations are something you very much need to be aware of. But again, we believe in long-term cash flow investing. And one of the benefits of the long-term cash flow investing is market fluctuations don't matter as much to that because you have a cash flowing asset that is generating income for you year after year after year. Sure, the value may go up and down a little. Over time, it should go up. But even when it goes down, it's just a number on a piece of paper to you. You own that real estate because of the money that it generates you. You're not focused as much on the appreciation and the value of that property when you're a long-term cash flow investor. You're more focused on the cash flow it generates. However, you always need to keep in mind that markets fluctuate. Prices go up and down, and you can't always plan for everything. So if the market drops and you lose your job at the same time, that can be a very dangerous situation if you need to liquidate your real estate at that time. So to overcome this, there's a lot of tricks you can do. You can leave a lot of equity in a property. That way, if that were to happen, you could still sell it and put money in your pocket. You can also prepay your mortgage for a year in advance. Maybe not the smartest thing, but if you're very risk averse, buy yourself a year of time at all times in all of your properties. There are ways to overcome some of these risks like market fluctuations. Another thing to be aware of with real estate is that it's typically a long-term commitment. Other than the fix and flip model, this is about holding real estate for long periods of time. And you need to be aware of that going into real estate. It's a very expensive asset, so it's not always the easiest to unload at a moment's notice. Now, don't get me wrong, real estate can be incredibly liquid compared to many other investments. But if you go into real estate with the idea that this is a long-term commitment and that it may not always be the easiest thing to exit in a short amount of time, then you will be doing yourself a great favor in advance by being aware of those. So simply put, when you invest in real estate, however long you think you're going to be holding it, just double that in your mind just for safety's sake. The last thing we would want is for somebody out there to invest in real estate and be stuck in a property that they didn't plan to own for as long as they own it. We know that's not always fun, so make sure to account for that when you're analyzing properties to invest in.